Welcome, everyone. Welcome. This feels like it's been a long week. Welcome to the Pirates of Finance. We're your hosts. I'm Corey Hoffstein. That handsome man to my right or left, I never know if this is flipped, is Jason Buck. We're coming to you from an undisclosed location deep in the Caribbean, much like the senior partners at FTX. Unlike the senior partners at FTX, though, we're not on the run. So at least that I'm aware of. Man, hell of a week.
Before you get to that, so let's kick the disclaimer, man.
No, I was going to get to the disclaimer. I was going to say, just like, look, this is clearly two random dudes wearing pirate shirts from hotel rooms somewhere in the Caribbean. Probably had a few cocktails before this started. Jason, I don't know about you. I was on a catamaran all day. I did avoid drinking. I know you were out and about. So look, with that all said, you definitely shouldn't take any of this as advice. Under no circumstances should anything we say be seen as a coherent, intelligent thought, most likely. So with that, let's kick it off. Jason, I know you think I'm going to go deep into this FTX rabbit hole because I've been in it all week. But here, I want to start with something different, which is that you and I are both podcast hosts. Beyond this show, we have our own podcast individually where we interview different managers. And I do mine seasonally. And last season, I had on Sam Trabucco, who at the time was the CEO of Alameda Research, who, for those of you who don't know, is sort of the hedge fund arm of what Sam Bankman-Fried built with FTX. It was sort of his pre-FTX endeavors, ostensibly a very successful, very large hedge fund until recently. And I'm questioning now. What I'm questioning is, what is my responsibility as a podcast host? Right? As I look back, I don't think there was anything in my interview with Sam that was particularly promotional about their hedge fund. I never intend my podcast to be promotional about my guest offerings. It's always, ideally, it's an intellectual discussion. Nor am I certain that there was anything nefarious happening a year ago. It seems like a lot of what I'm learning was a more recent sort of fraud that, frankly, Sam may not have even been in place for because he left being CEO earlier this year. So, the full story hasn't come out, but it's just got me thinking about, like, what are our responsibilities as hosts here?
Man, you're just starting deep. I thought you were going to give me a layup, but you're going to go there. By the way, shout out Rod's in the comments. He said, I'm actually Jason's 5 coffees deep. He's absolutely right. I was a good boy at lunch. I just went all pure coffee the whole time. May not have been a good boy at breakfast, though. That's to be debated. And by the way, if you want great investment advice, I would say turn into Resolve Riffs after us. Like that's the podcast where you get great investing advice. Right. We don't give any investment advice. We don't know advice here. It was interesting when you said that, when you started to reference, having Sam on there. I was actually thinking, I was like, in my head, I was going through the Rolodex of your podcast guests going like, is this how I short markets? Right? So I look at Corey's past podcast.
You're an asshole.
It's like, this is where I find my short thesis. No, I disagree. So this is a great perspective. The way I always look at it, especially when we're doing interview shows or podcasts. So like your interview, like the way you do your podcast, the way I've done stuff for Real Vision in the past. I think our job as hosts or interviewers with the interviewee is to kind of steelman their argument, like allow them to express their opinions and not for us to attack it. That's not the venue. If we had a different show where it's much more of a conversation and much more pushback like we do here in person and stuff like that, then that's an entirely different show. But to me, if you're having somebody on an interview, no, you don't need to worry about indemnification or anything. You're just allowing them to tell their story. And just like you started with the disclaimer, everybody else has got to do their own due diligence, and it's caveat emptor all the way down. I can understand what people say we should push back, but like I'm not sure that's our job in an hour-long interview. Like you got to give somebody ability to speak.
Well, I do push back. So not everyone would necessarily be aware that before I have my guests on, I do an hour-long pre-call, and I have screened out guests in the past that I was either uncomfortable with them as guests or I wasn't able to validate their claims. As my podcast has gotten more popular, I've had more people reach out. But I've had a few guests on, nothing as big as this, but I've had 2 or 3 guests on that people have sort of reached out to me privately and said, story isn't actually what you were told. And I do the podcast really more as a passion project. It's not like I'm earning a huge amount of revenue from ads there. I don't even put ads this season. I do it because I like having the conversations. I think it's opportunistic for me from a marketing perspective, but it is having me ask some very serious questions about my responsibility as a host. I don't know. It's a tough one. Again, I'm not like concerned about liability necessarily.
Yeah.
It's just more like I feel a responsibility to the audience, right? And when you're creating content, you're gonna make a mistake at some point, and having someone on who just gets one by you.
That's what I'm saying. So, like, how much time do you want to spend on due diligence, right? It's a time allocation issue, and like you said, you do your best, and you earnestly try to present people that like in the best light, and also have people on that, like you said, you try to filter a little bit, but inevitably somebody's going to slip one past the goalie at all times, right? It's just inevitable. If doing as many podcasts as you've done, that's an inevitability, right? Like at the end, like that's the way you have to look at it, and God, I'm trying to think of like, there's so many things, like so many directions I wanted to go in with that, but like, I don't know. I really don't know. Like, this kind of thing bothers me too. Like, I worry about it all the time because then people are thinking, are you using your credibility to give somebody else a platform? And people are lacking their due diligence and caveat emptor because they're expecting you to do it for them. Almost like the way smaller VCs will just like they're like succubuses. Like they latch onto A16Z, thinking if A16Z made an investment, they did their due diligence and they use it as a proxy. So, like you're saying, are you worried that people are going to use you as a proxy and assume Corey did his due diligence, and therefore?
Yeah. Look, I've had people come on my podcast and then try to use the fact they were on my podcast as some sort of verification.
Yes.
And I've said to them, do not do that. I will take down your episode. You being on my podcast is not some sort of verification that you, first of all, it's fucking me. Like, that's nothing to be excited about. You're on my podcast. But like, you cannot use being on my podcast as if I did some deep due diligence. That said, I do try. Right? Again, I've had people reach out who are private investors who've talked about running systematic strategies, claiming to have made hundreds of millions of dollars doing so. And I have done my homework to verify whether that's true or false by looking at track records and documents and all that sort of stuff behind the scenes before I even have a conversation with them. I reach out to people in my network to see if they know these people. You know, you got to do some semblance, because it does look poorly upon you if you do, have a whole bunch of frauds on, sort of you lose credibility. So there's a credibility risk there. But I question like how much how much should you do, right?
No, I'm laughing because I'm thinking about when you said that, it made me think of how many platforms have actually had frauds on, and their popularity only grows. So I'm not sure if that's a good moniker for it.
Yeah.
But like, as you and I always talk about too, there's an issue when you have to have guests on, right? And there's only like a certain amount of guests, and you're trying to vet guests, but you only have time, and you're trying to put a new season out, like how many guests you can have. The way I also look at it tangentially is like, at our firm, we try to have a no assholes policy, but guess what? We work in finance. If we had no asshole policy, we'd have nobody to talk to.
Yeah.
Like, so how do you
well, and sometimes you don't know they're an asshole till, look, I try to have my radar up, but it doesn't mean someone's not going to get one by me after 60 episodes, And again, I'm not even sure Sam got one by me. Like, it wasn't like he was promoting Alameda. Like, we talked about market structure and what yield farming is. And I don't know if anything fraudulent was happening at that time. And there's still rampant speculation. I'm not sure, by the way, like the facts have even truly come out as to what went down with FTX in the last couple of months. People keep trying to tell me what the pieces are, but no one's telling me the same story, which tells me like the evidence isn't fully out yet.
Right. And I want to get to that in a second, but it reminded me of like, so for example, you and I have known each other for years, and then we have mutual friends in common that go back decades and all that stuff. But it's not like you and I ran FBI criminal background checks on each other.
Right.
How do I know that you're not scamming me? Like this is a long con, or I'm not scamming you? Like
Well,
like
you were the one talking about long cons at dinner last night, buddy. If anyone's long conning, it's you. I'm not smart enough or patient enough for the long con.
I teed you up for that one perfectly. But so what you're saying, what's been interesting about what information's out, what's been really great is we're around a bunch of people that maybe have even deeper knowledge than you do about crypto and everything, and it's just
That's
rumors
easy.
and speculations
Yeah.
are rampant, right?
Yes.
And that's why, so like people are like, SBF is on the lam, and other people are like, SBF just got arrested. His plane was detained on the tarmac, and it's all just rampant rumors and speculation. And everybody's like, I know an inside employee at FTX. It's like it's still all speculation. So we actually don't know what happened. And what's interesting is even in hindsight, years from now, as we're picking apart the pieces, we're not going to know what happens. Like the Zapruder film. Like it will never be, every piece of the puzzle will not be revealed to itself. And then internally, like what's going to go on with like CZ and stuff, is he culpable? Was this a massive plot? Only CZ knows inside his head, right? And that's what's difficult at the end of the day is like,
well, and under what jurisdiction of law is any of this done? Right? I think it's either Bahamas or Antigua for the bankruptcy of FTX. But let's say someone wanted to do some lawsuit against Sam. Is it a class action in the U.S.? Well, first of all, U.S. investors shouldn't be there. So you can have class actions all around the globe. Who's bringing action against CZ? Under what jurisdiction of regulating body? Like these are big. Like this is a global issue of global investors. How does this play out? I think is a very interesting question. Tangentially, one of the things I would love to talk about, and this was part of my experience this week, is nothing about the fraud itself, but seeing how the market tried to react around this fraud as withdrawals stopped working at FTX, right? So you had, just to sort of tee this up, I don't know how many hundreds of thousands of accounts at FTX suddenly not be able to withdraw money. They froze withdrawals. And then the question became, what is there a way to get the money out that they haven't frozen? And if not, is there a way to monetize at pennies on the dollar by selling your account to someone else in some capacity? Either selling the account itself or transferring the funds within FTX. And I mean, just high level, the creative ways people started doing this is first, you had an OTC market for inter FTX account transfers. So while you couldn't withdraw money from FTX, FTX to FTX still worked. So you could pay someone outside of FTX, they could transfer to you inside of FTX, and you were paying for their assets penny on the dollar based on recovery. So there was a whole OTC market that popped up. There were entire large Telegram groups where like every second people were willing to bid, willing to sell. And you had like this order book of a chat room basically emerge. You had people figure out that you could buy NFTs and withdraw NFTs from the platform. Now, then it became a potential liquidity issue. You had people realize that there were withdrawals coming from the Bahamas. So if you could find someone in the Bahamas with a KYC'd account and you could buy that account, you could get it out for full dollar per dollar until about yesterday. Once they shut down intra account transfers, people figured out a way to use illiquid derivatives and trading algos to move money between accounts. So they would basically wash sale until all the money in one account moved to another through this illiquid derivative that they were the only one trading. And that's how they were able to do account transfers, even though account transfers were shut down. What blows me away here is like the scale and scope people have gone through to try to seize this opportunity of, hey, I think OTC market right now is saying it's 20 cents on the dollar recovery. I think that's cheap. I think that's rich. How am I going to trade that? And there was an entire market that popped up like this around that opportunity.
So there's a couple of things in there I want to pull on that you brought up. One, I didn't mention this to you last night, but somebody else here was talking about it a little bit too. Is like, so you have, obviously FTX US, you have FTX offshore, but then somebody last night was saying they actually have an FTX Bahamas account. And so they're lending that trading account to their friends to try to get money out. So like on FTX Bahamas, I think you could have gotten it out.
Yes, and so people were trying to send to FTX Bahamas as well as outright buy KYC'd FTX Bahamas accounts. So if you had an FTX account with nothing in it and it was FTX Bahamas and it was KYC'd, or you knew someone in the Bahamas that could KYC your account and push it through FTX somehow, you were able to withdraw dollar for dollar. It's going to be interesting to see through the bankruptcy how much of this gets clawed back.
Oh man, you hit on one of my bugbears. Sorry, go ahead.
I was just gonna say, with crypto, it makes it interesting because if it just disappears into the ether of crypto, how do you claw it back?
So we'll get clawbacks first. Then what drives me nuts is that there's a show on CNBC. I can't remember the name of it. But like it's the documentary show about people that commit frauds and everything on like CNBC, right? It's like hot money. No, I can't remember. Anyway, the idea though that always bothers me is like you said, when it goes through the bankruptcy or lawyers get involved and they start to do clawbacks. What's like unbelievable is like Madoff of the world, right? He may have donated like $10 million to St. Jude Children's Hospital. That's the first place the lawyers go to claw back that money, like 2 decades later.
Right.
And it's just like, it feels so gross, but I mean, they're doing their job. They're trying to claw back for the end investors that lost their money and everything. But it's fascinating. Like, I can't imagine being, like St. Jude's Children's Hospital and all these people are donating money. Like, actually, this is related to what you were asking about who you have on your podcast. How do you vet the people that are donating money to St. Jude's and then 2 decades later, it turns out they're a fraud and now they're trying to claw back that money that like you used 2 decades ago to help like families come to St. Jude's Hospital? Like, that's insane. But that's the way the clawback system works. So that's part of it. Like, the other one is the hard part I had is everybody's kind of circulating around this number of 20 cents on the dollar. Like, how comfortable are you with that? What's your margin of safety?
Well, and it was interesting is it was pretty steady. Like that was the midpoint. You had a lot of asks around 25. You had clearly people asking 50. They were never going to get filled. But like there was a stream of bids around 15, 20. People were crossing the spread at 20. I was party to deals that were trying to get done at 20 as a potential escrow agent. Like that's where deals were getting done, and it was stuck at 20 for like, I don't know, 8 hours for a while. Like there was a time period either 2 days ago or yesterday. The whole week's been a weird fuzzy blur. 2 days ago or yesterday where it was just like for 8 hours, that was the clearing price. And that's just where deals were getting done. And then suddenly it collapsed to like 5 cents and then 1 cent. And then all of a sudden, then things got weirder because documents started coming out that people thought the recovery would be way higher. Like Sam was saying, oh no, we've got 80 cents on the dollar for whatever his tweet was. So people were misinterpreting or potentially correctly interpreting what he was trying to say and saying, oh no, the recovery is going to be way higher. It's going to be 80 cents on the dollar once they go through bankruptcy. And the market just sort of, but then it dissolved because what happened is ultimately like people had to get way more creative to try to move these assets around. And like the average person trying to buy $100,000 account at 20 cents on the dollar. That's not the average person, but you know what I'm saying? Like they're not going to be painting the tape on an illiquid perp to try to create this account transfer. That's just not happening. Like this went into the realm of like real technical people.
So can you explain to me though, just so I understand clearly, what's the difference when you say providing escrow service for just buying up their, like offering them 20 cents on the dollar for their account?
Yeah. So think about the way, let's say I had an FTX account that had $100,000 in it and you wanted to buy it and I didn't know you, right? So what you're going to do is you're going to send me ETH or you're going to send me USDC to my wallet outside of FTX. And then I'm going to transfer you the money within FTX. But those are not concurrent events. Like, how do we make sure that it's actually going to happen and one of us doesn't defraud the other? So one of the ways it happened is people were sending incremental amounts. We're going to send you 1/20th of it at a time. And if I send you 1/20th and you don't send me the money back, it's a scam and I'm out 1/20th. The other way they were doing it is they were working with escrow agents. So I happen to be in the unique position of being a highly doxed public figure on Twitter who is SEC registered, right? My reputation really matters. And I also have a KYC'd account with FTX because I was a resident of Grand Cayman. And so, and that account had nothing in it. I wasn't trading anything on FTX. So I was in the unique position of saying, well, you don't trust each other. You can do this 1/20th thing and potentially get scammed, or you can work with someone like me where you send outside money to my wallet. The other person does an internal FTX transfer to me, and then I push them both through. Because if I scam you guys, I have real reputational risk. So I'm not going to scam you, but I am going to take a service fee. And those sort of services were popping up for people that were in that unique position of like, you could vouch for them as an escrow. And so a lot of times in crypto, being doxed is really not an advantage. A lot of people try to stay private for a reason. This was one of those cases where being doxed and being a public figure was potentially actually a real valuable service.
You gotta know. I love the sweet irony that you needed a centralizing Oracle figure in crypto to like provide escrows, like a trustable.
Well, you wouldn't necessarily. So because rewind back to, and I'm not even sure you're aware that this happened, but there was a DeFi project still around called DeFi Kingdoms, and it was sort of like gamified yield farming, and they had their currency, internal currency, was called Jewel, and they had, what would happen is you'd yield farm and you'd earn locked Jewel, and locked Jewel unlocked on a linear schedule, and locked Jewel you couldn't do anything with until someone figured out you could transfer locked Jewel, and it actually blew up the entire protocol. Like once locked Jewel could be transferred, the fake inflated value of Jewel went from like $60, it's like 10 cents now. It just blew the entire project apart. But people figured out you could sell locked Jewel, so they started selling it in different channels. And then the hedge fund MGNR created an OTC website, and they created a smart contract that said, look, you put a bid out there, you put your locked Jewel in here, or you put an ask, you put your locked Jewel in, and if someone hits that for the amount of ETH you want, we'll cross it, and we'll take a service fee for doing so. But the smart contract ends up being the escrow agent.
Right.
So it was just that I think what happened is there was no way to do this with a smart contract with internal FTX accounts, so you needed a third party. But it's this sort of thing has actually happened in the past in crypto with locked, theoretically locked assets, and you have seen smart contract escrow services pop up.
So that makes a lot more sense, because we actually, even though we've been around each other, we didn't have time to talk about this privately or really have any private conversations. It's like the escrow services now make a lot more sense, because I thought for a second you were trying to buy these people's FTT accounts for pennies on the dollar, and I was like, how is 20 cents on the dollar? Like, how do you even figure out a valuation for that? Like, that sounds insane.
Yeah, you could try to be a market maker here and buy for 20 cents, sell for 25. That would not work. Like, there are some people I know, and this is very shady, and when I say I know of them, who had a Bahamas account and knew they could get out dollar for dollar. So they started trying to buy accounts pennies on the dollar, knowing that they were going to get a full recovery because they could still withdraw. That's like weird asymmetric information exploitation of the market. I'm actually not even sure about the legality of that. All I was trying to do and be potential party to was, again, offering escrow services for people. Now, what I was trying to not do it for people I didn't know, because there's a anti-money laundering liability here, that if I did it for two completely anonymous people that were not KYC'd, and they were completely anonymous, and it turns out they were rogue state parties, like, that's bad for me, right?
Yeah.
So I was trying to make sure who I was doing it with were like known entities who just needed this particular service to facilitate the transaction. But for those parties, it became much harder because they had to talk to their legal teams. Like, there are funds who are trying to liquidate some of their holdings. Well, if you're a fund and you get a bid for 20 cents in your assets, like, you have a fiduciary liability to your shareholders potentially. How are you going to talk to your legal? How are you going to dot your I's and cross your T's? How is accounting going to deal with this? So what happened is they wanted to do it, and then they got really caught up in the legal aspect, and before they could pull the trigger, it all sort of fell apart.
Yeah, so there's two things I'm pulling there. One, so to be clear, you were never able to pull up any of these trades because it just
I wasted a lot of time. A lot of time mixing and matching on Telegram.
Yeah, you did and you didn't, though, because what I thought was fascinating when you originally told me about this is like the whole idea, if you can keep your head while all those around you are losing theirs. And then this gives us a venue to talk about like position sizing, liquidity, etc. What was impressive to me, even though, like you said, you wasted a lot of time on this, you were able to seize an opportunity, step in, and try to be the market maker, knowing you could take a vig on those services, and you had that ability because you didn't have your life savings tied up in FTT token, right? Like, right. You weren't involved in it.
Well, in defense of everyone else, I had already lost my FTT token in the Cream Finance hack a year ago. So it's not that I didn't lose FTT token; I just lost it before everyone else.
But even losing that, it was such a small bips of your net worth, that it didn't hurt you that much either. But that's what I'm saying is like, because you didn't have all your net worth tied to this, because you're broadly diversified, because you position size accordingly, it allows you to remain calm in these environments and go and see opportunities that you can't see creatively because when you're stressed.
Right.
And that's what I thought was impressive. Is like, to me, it was like you're like, I wasted all this time. And I was like, it was more impressive that you saw the opportunity to try to step in, and you had the ability to do so because you were calm and clearly seeing the picture, the state of play, and where you could help or take advantage of the situation.
Well, I appreciate the pat on the back there. I'll take the compliment. Yeah, candidly, I just got lucky. I think I didn't have any particular insight that FTX was a disaster of an exchange. I just made the decision many months ago that I never wanted to deal with crypto taxes ever again. And so I was moving everything to a cold wallet to prevent myself from trading. So really, it was just in filing my taxes, I saved my own ass.
I love it. Sean in the comments says, Corey is a hipster. He was losing crypto before it was popular.
That's right. Absolutely.
But at the same time, we talked about this before. Like, we feel like crypto boomers if you were in crypto before 2017. And then I've told you a billion times, like, I'm even way too early. Like, I don't know what's pre-hipster. Like, I'm waiting for my crypto kitties to have value again. Like, I was way too early.
Yeah, I'm definitely one of those people that has a hard drive with a Bitcoin wallet on it that I can't even figure out what the key is. So that's just gone, and I have no idea how much is in there. But yes, I'm one of those. It's not millions by any means, but I'm one of those stories of like, this was back in the day where if you left someone a comment in a forum, they just send you like lots of Bitcoin. And it was like, oh, this is cool. Like, whatever. So whatever. So this is insane. This like honestly, this week has been insane.
Well, like you said, it's everybody quotes that Lenin quote was like, years can happen in days or whatever. Like, the years when nothing happens, days when like feels like years pass. Whatever I'm butchering the quote. But like, as part of that, like you said, we don't like normally talking about anything topical, but we couldn't help ourselves talking about what's going on there. Talking about a face ripping rally yesterday that was just insane. And then more importantly, I'll tie it back to something else that's near and dear to both of us. Is on the way to this event, I had a stop off in Miami where I spoke at another event, and the topic of that panel was about how to allocate to trend following. And so did my panel top tick the market and trend following? What'd you take?
I don't know what to tell you. I wish we could just call on people. I don't know if Adam Butler happens to be in the comments, but I was talking to him yesterday, and he basically said, from a VAR perspective, every asset they trade had like a 0.1% VAR move yesterday. Like, just and this actually came up. I think we were talking about this last week or 2 weeks ago, like how trend had become a correlated trade. Right, that you saw it, long dollar, long commodities, short rates was all the same trade, and it all blew up yesterday. And trend's having another bad day today. I mean, it's not a good. And so, is it the top? Who knows? But this reminds me very much of like November 2020 when you had this event that all of a sudden changed people's risk appetite. Right, so you had the vaccines announced as being more effective than if I say vaccines on Twitter right now, a good thing we're not monetized anyway, but now we're banned. I wasn't even trying to say anything about COVID and vaccine. Anyway, so you had that November 2020 event that all of a sudden value did this ripping rally, momentum got completely crushed. You had this massive dispersion, and it felt like that's what happened yesterday. But I will echo something that Adam said to me that I agree with, which is I just don't trust one-day moves anymore in the market. Not that I ever trusted them, but to me, it seems so driven. I think I said this on Twitter, that market volatility is just the realization of positioning fragility. That
say that again. It's
market volatility is the realization of positioning fragility. And so when you have tons of players that are suddenly forced to cover or forced to hedge because a trade goes offside, like that's when, like, I'm sorry, I'm just going to say it, like the S&P 500 should not be making a 5% move. That is not healthy. Like, you should not be repricing the 500 largest market cap companies by free float plus 5% in aggregate. It just shouldn't happen in a single day. And so to me, that's just a sign of like, that's just as unhealthy as what you see on the downside. I'm not sure why suddenly like the CPI print coming in minorly lower was all of a sudden a face ripping rally, other than it's just hedging pressure.
Yeah, it's supply, demand, and imbalances, like you're saying. And so then that's what leads to those rips. But at the same time, we talked about it on our last episode with trend following and everything. Like, this is the expectation of this strategy. Like, every strategy has pros and cons, and you get long in the tooth in the trend, and it's aggregating down to long dollar short bond positions. And if it reverses, and like you said, so you shouldn't really, it's the hard part. You also shouldn't be emotional about a 1 day reversal, right? Depending on the speed of your trend following strategy. Like, this is part of the part for the course. It's almost like going back to the crypto discussion. It's like, if you've been in this game long enough, this is just the crazy shit that goes on here. Like,
right. Well, and look,
it's just not surprising.
And you use crypto as a trend following as an overlay. I use trend following as an overlay. Trend following has helped buffered losses in traditional beta in stocks and bonds all year long. So stocks and bonds rallied yesterday and trend following fell. So by comparison, I had a shallower drawdown than everyone, and so I'm having a shallower recovery. But net, I just have lower vol. So I'm not sure it really matters. Like, the 1 day feels painful, but it's like, well, actually, there was a lot of built up, I'm going to use alpha in quotes here, but relative outperformance because of the overlay.
And they said that pressure builds up for the face ripping rally to the upside. And then over time, if we do enough of those, then people start getting over levered to the upside. And then we have a face ripping rally to the downside.
That's absolutely right. I'm not sure I would call it a rally to the downside, but sure, I know what you're saying.
You can see what I'm saying. You're going to, I'm sorry, I got to pull out this comment because the nuances and the layers to this comment or question in the comments. I'm going to watch your brain melt on this one because I know where, like, you've been talking about this. It's like, do you guys have any insights into cascading failures across markets tied to FTX?
Yeah. Yeah. So
actually, we've been DMing about this stuff for days. So we got to talk about it.
So I will tell you what I believe. What do I believe? I believe that there will be contagion within crypto. And I think you're already starting to see it. Like, I think Galaxy claimed they lost 77 million. I think you're going to see a lot of write-downs from funds. A lot of market makers, by definition, had capital at FTX to make markets. I think you're going to see a lot of people who had money at FTX are now going to be, from their own loan to value perspective, like if they lose all that cash at FTX and they have debt elsewhere, from a loan to value perspective, they just have fewer assets. They're going to want to degross more. That can potentially lead to more selling pressure. Who knows what's going to, I don't know what assets Alameda still has and what's going to happen in the bankruptcy. So do I think that there can be more losses posted? Yes. I actually think this wasn't as bad as it could have been because 3AC and Luna already happened and a lot of parties degrossed. I do not see this becoming a global cross-asset contagion thing, with the exception of, like, I don't know, if those South American countries that were buying Bitcoin decided to custody it all at FTX, like, yeah, that's a pretty significant issue for those countries. But I'm not seeing this as like, okay, the Ontario teachers' pension had 50 bips of FTX equity. Who gives a shit? Like, yeah, it's a write down, but they should have already been writing that down from peak valuation. So I don't know. I'm of the view, like, I'm going to eat crow for this if there's
that's right. Okay. That's right. I'm gonna help us out here because this is a total setup for you.
Take the other side.
That's what I'm saying. This FTX is going to lead to an absolute cascade of liquidity, and we're all fucked from here. So now, a year from now, we can go back in hindsight and pull this episode, and we'll just pick whichever one was right, and then we'll look like we
scrub the other. Look, for me, like, contagion happens when there's knock-on risk, right? And often there's leverage involved, and someone defaults, and then that causes their counterparties to then subsequently default. That would imply that there are firms that hold enough risk in crypto, as well as a significant amount of traditional finance assets, that by capitulating in crypto, they're going to be forced to sell their traditional assets. And I just don't think the crypto universe ever got to the point that it had mass institutional adoption in a meaningful way that this will spill over.
I love that. What I actually love about this discussion is, like, one of the few times I've seen you take a stance, which is, like, surprising to me, like, in that sense. But, like, at the same time, it's totally unfair. Like you were referencing Canadian pensions and everything. Going back to 2020, everybody started ripping the Alberta pension because they lost $2 billion shorting VAR swaps. And I'm not going to pile onto that, but I was like, okay, let's talk about that in context. What's the size of the Alberta pension fund? $200 billion. They lost 1% shorting variance swaps. Like, should they have not shorted variance swaps and not blow up to $1 billion and incinerate? Absolutely. But in context, it's 1%. Like, you got to realize what the context of the size of these funds are. They're absolutely enormous. But then to your point, like to also give you an out, the problem is with liquidity cascades, and is this going to lead, is this the trigger or the impetus or the catalyst? You only know that in hindsight. Like, what drives me nuts, everybody talks about the assassination of Archduke Franz Ferdinand, and they saw it all from there. No, powder kegs are existing. It's sand pile effects. You don't know what the straw is going to break the camel's back. But in hindsight, you can go back there and say, it was patently obvious. Here's where it was. And that's what you're more saying too, is like, you don't necessarily see it, but then could we go in hindsight and say this? But then like, could we go prior to this and point out the other things? Because then you could go, like you said, it could have been Luna, right? And then you could say Luna led to FTX, which led to, like, you could say all those things. The other thing I want to bring up that's slightly tangential but related, that I think is fascinating that you and I deal with on a daily basis, is part of the Alameda or FTX or FTT, whatever you want to call it, is when crypto volatility came down so low, right? Everybody was always talking about crypto so volatile, Bitcoin so volatile. As a trading firm at Alameda, as soon as volatility came down, people start leveraging up positions to achieve the returns they got before in a high vol environment. And once you start leveraging up, you're bringing in that fragility or that cascade effect that can happen.
Yeah. I got to tell you, leverage has taken a real L here on this one. Once again, it's just like, well, it's really more like quants with leverage. This isn't helping.
Exactly.
Like, God damn it. Why is it always the quants with leverage that seem to blow things up? It's not a good look for us, honestly. It's concentrated leverage is just a dangerous game to play. It's a dangerous game to play. And I am a big proponent of leverage. You know that. I think leverage, when applied to unlock the potential benefits of diversification, is a huge tool that shouldn't go overlooked. Doesn't mean you should lever yourself way up, but I think it's a tool that we shun in the industry in a way that we shouldn't necessarily.
No, that's perfect. Like you said, it gives leverage a bad name. You guys fucked us again. But as you and I discussed, it's like everybody, when we started to talk about prudent leverage, and if you use broad portfolio construction and you use offensive and defensive assets or log ball assets, and you use portfolio leverage, and you're not using sharp world or variance, or variance or volatility as a measure of risk, that's a different thing. But everybody goes, no, leverage is bad. You go, wait a second, let's back up for a second. Every time leverage is used in a short ball trade, shit blows up. You're not talking about using leverage in a short ball trade, but leverage gets a bad name. And it's so funny, everybody has to dance around it. We use portfolio volatility. We use embedded or implicit leverage. Like, you're trying to dance around the subject because leverage is just across the board pejorative word, but like every word, there's nuances to it, right? But all the times leverage, yes, leverage on a short vol trade is going to make you either rich or poor. And we'll see in hindsight which one happened over what time horizon. But that's when you leverage up short vol trades. It doesn't mean leverage is a tool. It's not inherently good or bad. Is that a fair way?
Yeah, leverage is a tool. Look, even on the levering short vol trades eventually blows you up. I mean, if I tell you that I'm levering up 2-year U.S. Treasury futures versus buying an ultra U.S. Treasury future, which one is riskier to my capital? The question is, how much are you levering up those 2 years? Because if I put $1 into the 2 years, the vol of that is so low compared to the vol of buying a long-dated treasury. I can lever that 5 or 6 times before I even get to the vol level. Now, do I still think that introduces a unique path-dependent risk? Absolutely. There is that path-dependent risk that gets introduced that you don't have when you buy without leverage. That is universally true, in my opinion, not something you can avoid. But, I think under with full acknowledgement of that, I could lever up 2-year U.S. Treasuries 5 times before they even start to come anywhere close to the vol of long-dated treasuries.
Exactly. And there's just so many things. I don't even know where to go. But the part of that is, speaking of that leverage or figuring out where your risks are, One of the things I had with one of the panels or the room I was in, we were talking about there is not only was it commodity trend following and all that stuff, but it was also volatility and derivatives and that sort of thing. One of the, as it's been a rough year for equity vol or deep out of the money equity vol, depending on your strategy, right? But like just outright buying deep out of the money puts, obviously a tough year because skew was so high at the beginning of the year, skews come down, which is both. I'll get to that maybe in a second. What's fascinating to me is like, if you've been buying skew all year, it's been a tough year, but now skew is the lowest it's been in about 2 years. So it's like, it's you got more convexity again to buying skew.
Right,
So that's
right.
one thing talking about equity vol skew. But what I'm actually getting at, because I really want your take on this, is one of the trades that somebody brought up, I'll just say this, I'm trying to make it as generic as possible, was long VAR swaps and then short S&P vol. And I said, okay, but
long the VAR swap, short the vol.
Yeah, long VAR swaps, but then short S&P index vol, like listed. So I was like, I got you, but now you got to get your ratios perfect.
I was gonna say, like Vega neutral. How are you?
And then you've got
like I get it. It's in theory it's a convex trade,
in theory,
right?
In theory, that's my
theory,
point.
you have convexity, right? So long the variance. Variance is just volatility squared. So you're going to win in the tails, but the variance swap is likely trading at a premium because of the convexity. So you have to pay more per unit Vega, I would expect. I need Ben Eifert to tell me these things.
Yes.
Right? Someone who's actually trades variance swaps or has historically for a living. But I'm pretty sure you're going to pay more per unit Vega because of that convexity. And so if you're trying to be Vega neutral, that is going to be a negative carry trade, which is fine, right? That's what a tail hedge should be. It should be a negative carry trade. I'm not like, I got to think about this one. This is where you get in trouble with a live show. You're giving me off the cuff. I'm not against it because you're long the convex thing. I would be against long vol swap, short variance swap.
Of course. But that's what I'm saying. That one's obvious. But what's interesting is like what you're getting at is like, if you start shorting, like volatility squared, and then you're long volatility at a higher multiple, or that has a convexity to it that actually goes up exponentially, like you said, and then that's all fine. Like you're saying, you're still long vol because you're long the variance swap. But like you just said, if then your secondary effect is you want to be carry positive or carry neutral, then you're off integrating. Like, what's the tricky ratios?
Yeah, this is one of the most annoying things. And I was listening to some podcast earlier this week that was talking about this, and I don't remember who it was. And I apologize for not giving credit where credit's due, but they were basically saying like, know who it was? It was Dennis Davitt on Alpha Exchange. Alpha Exchange, phenomenal podcast. Dennis Davitt, I had him on my podcast. He's a really smart guy, really thoughtful, options trader. And basically said, look, like you should not be able to have a carry neutral or positive carry hedge. Right. Like that, you should not be able to buy insurance and get paid for it. So there's either a massive dislocation in the market, which can happen, right? That happens from an event where parties are forced to delever. You can potentially find those situations. But that is not the norm. If you are looking at S&P options, like that is a highly competitive liquid market. There's no alpha sitting there. You just have to assume the market's efficient. And so no matter what structure you create, if you create positive carry, there is likely a path dependency that you are fucked.
Yeah. So I'm glad you took it there. That's perfect. Because this was a topic of conversation at the prior event I was at. If somebody's saying they can get you positive carry hedge, right, then you should really know what you're doing and looking into, and you should know how to deep dive in there because they're taking shortfall risk somewhere else, right? They're either they're doing a paired trade, they're doing spreads, or they're doing ratio spreads, and you need to really know where the short vol part of that book is, or they're doing relative value, which has a short vol component to it, and you better make sure people are getting the ratios right. But more importantly, this is a question that came up, and of course our homie Vanir Bensali knocked it out of the park. He agrees with exactly what it is. A person asked, where do I find positive carry hedges? And he said, once again, you don't. What you do is the rest of your book is maybe long GDP or short vol in the rest of your book, like by being long stocks, long bonds, long PE, long VC, long real estate. That's where you get your positive carry. And then your hedges are negative carry, but it's about the emergent, what's the emergent property of that portfolio in combination. Use the negative line item like insurance. Like there's no positive carry insurance on your house. And
Right.
so that was Veneer's point that, as a man after our own heart. It's about portfolio construction, trying to find positive carry for other assets in your portfolio. And your insurance should be a negative cost. And then you try to, there's ways to try to limit that cost as much as you can. But to do that, there's going to be trade-offs that have a implicit short volatility bias to it to try to limit that bleed.
I do think you can have positive carry hedges, right? That
Yeah.
appear to be positive carry hedges. There's just a path dependent risk. A perfect example, because you and I we can talk about all this option stuff, and maybe it's not as transparent to people who are listening. But just think about treasuries, right? For the last 30 years, they appeared to be a positive carry hedge.
Right.
That you earned a positive interest rate. Ignore the declining interest rate. Everyone thinks declining interest rates were really important. They weren't. You just earned a yield. That's what mattered. And during a crisis, they were the flight to safety asset because they're what backs the reserve currency. Everyone who needs to buy collateral, that's what gets posted as collateral. Like treasuries are the de facto insurance asset that gets bid in a crisis. So you have something that's going to pay you a positive value and it's going to benefit in a crisis. Perfect hedge. Well, yes, but there was an outstanding path-dependent risk called inflation. And it took 30 years to come back around, but you're seeing it this year. It's clearly not a hedge in all scenarios. So it really wasn't that it was a positive carry hedge. It was that the realized history over the last 30 years made it look like a positive carry hedge. It's just that you didn't realize the path over which, that really didn't work. And so that's like when we talk about, like, that's what makes markets so hard is like, we're only seeing one realized path. And the realized path is really just sort of I think Mike Green says this. It's just like a trade log, basically. All we're seeing is like the prints are literally just a trade log of what was traded. And that doesn't mean that's what could have happened or should have happened. It just means that's what did happen. And we look at history as if it's fact versus at any given point in time, there was a statistical cone of things that could have happened.
I love it. You're coming more and more over to my dark side every day. I love it.
I know.
Like nobody does anything.
Here's the real problem is I'm trying to recognize that the more I come around to like your dark side, the more this show just becomes we really have nothing to say. I mean, it's already that way, but it's like, we have no views and it's all statistical noise.
So you did touch on some things I want to pull out that you teed me up perfectly for. So like you just said, if you had a positive carry hedge in treasuries, you should have been questioning that, right? That should be an anomaly. Granted, the anomaly persisted for 3 to 4 decades, but there's no such thing as a positive carry hedge, and now people are paying the price for it. But if it lasts for 3 to 4 decades and that was your ergodic time horizon, good for you, good on you, like you won. But that on the long arc of history, that's an anomaly that shouldn't exist. What I love about what you said there too is going to tee you up is like, so then Veneer start talking about what are some positive carry hedges that can pop up, right? Like you can have things, these anomalies, almost like, is it 3-4 decades on the treasury market, or you get these anomalies, as we know, some of our favorite relative value vol traders are looking for those disturbances in the force, and they find these little things that pop up here and there if you're paying attention. But what I love is one of our favorite subjects is path versus terminus. So I love to tee you up with this one. So Veneer said at one point they had a positive carry hedge when he shorted German bunds at 103, right? With par being 100. So terminus, it had to come down from 103 to 100, right? So he felt he was putting on a positive carry hedge to inflation. And he shorted from 103 to par at 100 for the terminus. But as you and I know, and then he ended up covering it at about like, I think it was like 75, 80, somewhere in there, right? So obviously he won on that trade, but I could see you getting uncomfortable because that path could have been pretty horrific.
Yeah, that's really, first of all, I need to have the humility not to disagree with Veneer, right? He's a brilliant guy. So let's just start there. Like, I'm already starting at a disadvantage here. He's a brilliant guy. And he's not here to
talk about nuance. Yeah.
But I think you hit that one perfectly, which is if you can put that short on, I don't know what just happened to my video. Did I just disappear?
No, I can see it fine.
Oh, and my video just totally disappeared on my end. Anyway, I'm back. If you put that short on, right, shorts are inherently a levered trade. And so anytime you have leverage, you create a path-dependent risk. Like you have to manage the path. And so you're absolutely right. Like if he could put that trade on and know he'd never get carried out of that trade, like and he would never get a margin call, very cool trade. Very cool trade. But there is a path, in theory, that what if all of a sudden rates were cut because some severe recession happened again and he gets blown out of the position. Like, it's just like, again, if you think there is a positive carry, that positive carry is compensation for a path dependent risk that you were likely blowing up on.
And then clearly, like you just said, one, Veneer's never going to listen to our podcast because Veneer's much smarter than that. But two, this is not what we're talking about. Like, Veneer obviously knew that risk and he position sized accordingly. So Veneer's well aware of everything we're saying. But I just thought it was a good proxy for us to kind of like talk about.
By the way, his books are fantastic. Everyone should read his books.
Oh, when I went on stage the other day, I said, I don't know why you're up here listening to me. Just go read Veneer's paper on diversifying your diversifiers.
Yes.
Well, actually, I think Corey Hofstein was the first one to say diversify your diversifiers.
I don't know if I was the first. I was definitely early when his paper came out. That was diversify your diversifiers. I was like, this feels like it's stepping in my territory. But I also say a lot of bullshit that I get credit for that I probably didn't even say in the first place. So.
Well, as you know, if you're a prolific Twitter account like yours and a prolific essay writer and now a podcaster and YouTube host, is like you can put a lot of stuff out there and then you could just look back and say, I said that.
Monkeys with typewriters, buddy. Monkeys with typewriters.
Throw enough shit at the wall. So, one of the questions, the comment from Jay, I would just want to bring this up because it came up at our lunch today at the table I was at about liquidity. How do you, is there a good metric or place for retail investors to find a proxy for liquidity across asset classes, right? And we started having this conversation about Mike Howell and his unbelievable research on liquidity and global liquidity and the way they look at liquidity at, was it Cross-Border Capital, I believe is his firm. And if Mike was here, I think he would answer the same question. Is like, they do an amazing job. They're some of the best in the world at it, but you're probably still only getting 80 to 90% of the picture. You know, around the periphery, they can't account for all the liquidity in the world and how all of the liquidity manifests itself. And so liquidity it's still always decision-making under opacity. And especially on the retail side, there's no way you can assess liquidity. And I think even Sean at the comments wrote that, like, we talk about this all the time, but like, even like with Ben Eifert and even talking about like, how do you know where the big players are in vol space or whatever? It's like, it's a Bloomberg chat, right? It's the relationships you've developed over 2 to 3 decades to talk on Bloomberg chats, to start thinking of where, you know, large non-economic hedgers are positioned, or where the Canadian pensions, you know, or the avatar for the London whale, like all of that stuff it's all rumor and speculation. And we're trying to create this kind of dot plot of where all this liquidity is, but at the end of the day, nobody really knows. And this almost goes back to your thing about, is FTT the sand pile cascade? It's impossible to know that because we don't know where all the liquidity is. We don't know where every player is positioned. And then you start going offshore and Eurodollar markets. It's like, there's no way for anybody to know what the liquidity picture actually looks like.
Well, and to measure liquidity, because you do see a lot of sell side notes that talk about, oh, liquidity and equities is the worst it's been in a decade. And what does that mean? Well, a lot of times what they're meaning is like, what's the depth in the order book? But what you don't see is like, markets move fast enough at this point that like, who just has standing bids in the order book anymore? Right? Like, you don't need to. People can drop in liquidity very quickly. They can pull liquidity very quickly. Liquidity is very phantom. Here's a question: if I run a fund and I have someone who wants to make a large withdrawal and someone who wants to make a large purchase of the fund on the exact same day, one person can completely get their money out, one person can completely get their money in, and that only happens and there's zero trading that occurs, because what happens is they just literally swap cash and asset within the fund. Like there's cash that comes in and cash that goes out, and nothing ever trades. Well, the fund was very liquid on that day, right, for both parties, but nothing ever hit the tape because they just crossed. And by the way, large fund companies have the ability to cross. If you have money coming in one fund, money coming out of another fund, you might be able to cross positions and find liquidity that way, and it'll never hit the tape, right? Yep. And so you have to be aware, like, there's a huge amount of liquidity that exists in the industry that never hits the tape.
Perfectly said. And I'm just going to expand on that. By the way, one of the questions was, they asked who we were talking about with Veneer. Maybe the best way to look it up, his firm's called Longtail Alpha, but it's Veneer Bhansali, Vineer Bhansali. Veneer Bhansali at Longtail Alpha. Hopefully then you can find him there. Look for Longtail Alpha and you just look at all his papers. They're phenomenal. Also great papers if you're into like geeking out about convexity and vol is at Convex-Strategies, where David Dredge writes too. All this stuff's like free and you can find it online. No, you just nailed it. Like, what drives me nuts, and I can understand why people do it. is sometimes traders have a feel that the markets aren't as liquid as they think they are. And then so then they point to the level 2 order book and say, look, there's no liquidity there. But that they know that's disingenuous. That's not true. Because like you just said, like we both work with all these execution desks, and the execution desks have iceberg orders, they have algorithmic order execution. It's a cat and mouse game. They're doing red queen principles. So you're not going to see that in the level 2 order book. That's like 1990s shit. Like the world has advanced against that, right? And we're all battling it out and all using all these algorithmic order executions between them. Then you said like there's dark pools where people get matching orders, or more importantly, that Ben Eifert's pointed out so well, it's a time horizon issue. When you're getting your trade off, if you need to get rid of that trade right now, you might not have liquidity. But if you can work that trade over the next few hours, the next few days, there's enormous liquidity. So that's kind of the issue is like, so it's not that simple. Like we're always trying to deal with is like, there's a lot of nuances here. Like, and so like you just said though, too, to get a picture of that liquidity, there's no snapshot you can find that will tell you all this liquidity because everybody's trying to hide that liquidity. So I don't know, like whether the market's liquid or illiquid.
Yeah. You don't know whether something's liquid or illiquid until after you've traded. Like that's the only way I can put it, right? You figure out your impact afterwards.
Perfectly said. Another way to say it, and this is related to this where we started the conversation. I've always loved the quote, you never know how much somebody's worth until they declare bankruptcy.
True.
So do you have anything else you want to touch on? Because we're running up on time. We're running into our homies podcast time too, so we don't want to do that. Other than that, you know, we're having much more. We're having a lot of interesting conversations here that hopefully you and I could probably be prepared for next week. Not that we ever prepare for the show, as you can tell.
Yeah, and preemptive warning, I'm going to have to rebook next week's conversation because I'm having to travel next Friday. So we're going to figure out when we're doing it. Listen, man, it's last minute. I know. This is why I wanted to bring it up last minute.
Unbelievable.
I got to tell you, like, doing a podcast during the pandemic was a lot easier than doing a podcast when travel's back.
1,000%.
Yeah.
But like a good partner, I make sure I block off Fridays just for you.
I don't know what to tell you.
And
I don't know what to tell you.
You know what? Like this morning, I was talking about it at my breakfast table, and I was like, I don't, listen to what people say. I watch what they do, and you're showing me through your actions how little you care about me.
You are a much better partner to me than I am to you. That is absolutely true.
I just want that on the record.
That is on the record.
All right. Do you want to do the disclaimer before Tyler rolls the outro?
Yeah, ladies and gentlemen, thank you for joining us again. This is the Pirates of Finance. You can catch us, I would say every Friday, but it's really whenever we go on. We're trying to create weekly content. We appreciate you being here, whether you're tuning in live, World's Famous Booty Crew in the comments section. Thank you for being with us. If you join us after, again, thank you for your time. Again, none of this is financial advice. Two random guys you're watching on the internet, just shooting the shit, but we appreciate your time. Thank you, and enjoy your weekends.